Have you ever wondered how two identical companies selling the exact same stuff can end up reporting totally different profits? Well, it's not magic, it's inventory accounting. And today, we're going to pull back the curtain on this hidden financial strategy and see how companies really count their stock. Okay, let's jump right in with a little puzzle. Imagine you own a bookstore. In January, you buy a book for $10. Prices are going up. So in February, you buy that same exact book, but this time it costs you $12. Then in March, a customer walks in and buys one copy for $20. So here's the question. What was your profit?
Well, here's where it gets tricky. It actually depends. See, if you say you sold the book you bought in January, your profit is $10. But if you say you sold the February book, your profit's only $8. They're the same book, but the story you tell completely changes your bottom line. So which one is the right one?
Now, this isn't just some brain teaser. This is a fundamental choice that every single business with inventory has to make, and it has massive consequences for their income and, you guessed it, their taxes. This is the profit puzzle we're going to solve today.
In the accounting world, this choice has a name. It's called a cost flow assumption. It's basically the story you decide to tell about which item got sold. But before you can tell that story, you've got to be absolutely sure about which items are actually yours to begin with.
It sounds super obvious, right? Of course I know what I own, but ownership can get surprisingly complicated, especially when your products are on a truck somewhere or sitting in someone else's store.
And here is where a tiny little acronym can change everything. If the shipping terms are FOB shipping point, the second that product leaves the seller's warehouse, boom, it belongs to the buyer. But if the terms are FOB destination, the seller still owns that product all the way until it physically arrives at the buyer's doorstep.
So what about consigned goods? You've seen this. It's when a brand has its products for sale inside another company's store. Well, here's the thing. The store selling the items never actually owns them. They stay on the original owner's books as inventory right up until the moment you, the customer, actually buy it.
Okay, so now that we're clear on exactly what inventory we own, we can get back to our profit puzzle. Let's dig into the first major philosophy for tracking all these costs. It's called FIFO.
First in, first out, or FIFO, is, well, it's pretty much exactly what it sounds like. The company just assumes that it sells its oldest stock first. It's a really simple but powerful idea.
The best way to think about this is a fruit stand. It just makes sense, right? You want to sell the apples you bought on Monday before you sell the fresher ones you just got on Wednesday. Otherwise, they'll go bad. That is the simple, intuitive logic behind FIFO. It perfectly matches the natural flow of a lot of physical products.
And here's where it gets really interesting financially. When prices are on the rise, FIFO matches your old, cheaper costs against your new, higher sales prices. What does that do? It means your cost of goods sold is lower, which makes your profit look higher. And the inventory you still have is valued at the newest, most expensive prices.
All right, so now let's flip this whole thing completely on its head and talk about the other major philosophy, LIFO. You'll see how it builds a totally different financial story by using the exact opposite logic.
Last in, first out, LIFO. You guessed it, it's the complete opposite of FIFO. Here, you're assuming that the newest, most recently purchased items are the ones that are flying off the shelves first.
Now, this might not make a lot of sense for fruit, but picture an elevator. The last person to squeeze in is usually standing right by the door, right? So they're the first one to get out at the next stop. That's the logic of LIFO. It's a great reminder that the accounting flow doesn't always have to match the physical flow of the products.
So you can see how this totally flips the script. In that same situation where prices are rising, LIFO matches your newest, most expensive costs against your revenue. This makes your cost of goods sold higher, which makes your profit look lower, and it leaves all that older, cheaper inventory sitting on your books.
So you've got FIFO and LIFO, two completely different stories about the exact same business activity. What does this showdown actually mean for a company's financial statements, and maybe more importantly, for its bank account?
This is where the real strategy kicks in. When prices are going up, FIFO gives you a higher reported profit because it's using those old, low costs. LIFO, on the other hand, uses the new, high costs, which results in a lower reported profit. And here's the key connection. Profit is what you pay taxes on.
Let's actually put some numbers on this. Using a more detailed version of our bookstore example, you can see the difference is pretty dramatic. With FIFO, the company reports a gross profit of $10,600. Under LIFO, it's only $8,600. That is a $2,000 difference in profit from the exact same sales, just by changing the accounting story. Now, the choice isn't just a simple coin toss between FIFO and LIFO. There are actually other methods and systems that add even more layers to this whole decision.
For companies that don't really want the extremes of either method, there's a compromise, the average cost method. It does exactly what it says. It calculates a weighted average cost for all the inventory you have, and then applies that one average cost to every item you sell. It basically smooths out all the price bumps, giving you a result that's somewhere in the middle.
On top of all that, a company also has to decide how often it's going to run these numbers. A perpetual system updates the inventory records with every single sale. It's a lot more complex, but it's super accurate. A periodic system is simpler. You just do a big count at the end of the month or quarter.
So that brings us to the big question. Why on earth would any company choose LIFO, a method that intentionally makes the profits look lower? Well, this quote right here, this is the secret. The bottom line is that lower reported profits mean a lower tax bill. And a lower tax bill means the company gets to keep more cash.
So you see, it all comes down to this. The accounting method a company picks sends a strategic signal. Do you want to use FIFO to look as profitable as you can for your investors? Or do you want to use LIFO to lower your tax bill and keep your cash flow as high as possible? It's not just about counting stuff. It's about business strategy.
And that leaves us with one final thought for you. If you were the one in charge, what would you choose? What story would you want your inventory to tell? Would you prioritize the story of higher profits for the world to see, or the story of lower taxes and more cash in the bank? It's a choice every single company with something to sell has to make.